Hey folks, so obviously we continue to see a very heavy bid in the equity market here over the past, not only the past 2.5 months, but over the past few weeks and really the past couple days. And so we've been getting a lot of questions of, hey, what's going on? You know, are we really going back to all-time highs? And I wanted to kind of shed some perspective on this because it has also, to be fair, surprised us how strong the equity market has been. But if we contextualize it, and hopefully we're going to give you some perspective here, you can see why it's happening, why it makes a lot of sense, and why it's probably very limited from here in the upside in the bigger scheme of things. So if we break down the reasons why things have rallied so strongly and why it's continued, it's really two things. Number one has to do with liquidity, and if we look at the chart here, this is a very simple chart that I created of the M1 money supply. If you don't know what that is, it's essentially money printing, if you will, or money going into the system. The Fed and other central banks around the world essentially backstopping I guess a worse near-term collapse. Some of it I think was very, very justified and quite frankly very important to do. But it's essentially flooded the system with money. You can think about it in a small way. For example, the stimulus checks that individual Americans got that made below a certain amount of money. You can kind of think about it that way. If you make that money and actually a lot of people invested that in the stock market or are still investing in the stock market. And if you look at it in the bigger sense and you look at what the Fed did, what it's doing in terms of some of its other programs that it's doing for corporations, for small businesses, and for banks, then you can kind of extrapolate that stimulus check example I just gave you, and you can imagine how much larger that is, how much more money there is in the system because of that. So this is one thing, and this has in turn led to the second part, which is, or the second reason why things continue to go higher, and which has ultimately led to really what's called performance anxiety on the part of fund managers, and then chart chasing on the part of individual folks who are putting that money into the system that are unfortunately often very, very inexperienced. And so let me quickly show you, first maybe going to this second part here. This is just giving you a simple idea. Let me get rid of some of these things so we don't confuse things too much. But this chart here, and I know it's not very large, but this basically tells you how many Robinhood accounts, which is this free trading app, a lot of millennials, and I've mentioned this before, but it's unbelievable how many people that have very little experience, and this is not making bad people, it just makes some people with less experience are coming into the market now when we've, by all intents and purposes, have a pretty bad recession going on, and this is in a large part, not actually shouldn't be a large part, but it is a part of what's pushing markets higher. And we can see this from our Twitter stream. We can see from conversations. You can see the kind of people that are now getting bullish that haven't been bullish for the past decade. It's a very different crowd than the crowd that has, I guess, more experience and isn't necessarily buying. In fact, is selling into rallies. So this is another point. And then getting to really, I guess, the meat of point number two is the chart chasing on the part of portfolio managers that are underperforming, and this is kind of what we continue to see. As the S&P started breaking, probably I think as particularly SPY, we can look at the SPY ETF for a minute. As it started breaking around 2,800 or so, you could start to see a different kind of person coming into the market, a different kind of, not that kind of person, but a different type of buying that was happening, and a lot of it was kind of panic buying, and that's become especially true over the past 2 weeks as the SPY once again broke above, in this case, 2,900 or so, 290 I should say in the SPY ETF. And essentially think about it this way: portfolio manager, if they underperform their benchmark, particularly if they're supposed to be bullish, and they miss a bull market, they're going to get fired. And so a lot of these guys are very, very scared. They have to, a lot of it's even algorithm driven. There's a third point, by the way, to all this, which I'll just quickly touch on in just a second. But a lot of this could even be algorithm driven, that's making these fund managers go longer or get longer in terms of adding more gross exposure. And so this is essentially what's happening. But we do think ultimately this is very capped. And I'll quickly show you this, and then I'll get to point number three just real briefly. But the reason why we think it's capped, I mean, there's many reasons, by the way, but just to give you a very simple statistic, which I think I've even mentioned here on YouTube before, is this one here. If you look at the, when you have a real contraction in employment, for example, we had in 2002, 2003, or we had in 2009, 10. It doesn't just take a couple months to get back to full employment. It takes years. You can see 48 months and 76 months respectively, just from a purely mathematical perspective. Forget the whole psychological aspect of people being afraid to go out. If you have an economy that's 67, 70+% consumer spending driven, and it's going to take years to get back to full unemployment, where are these people? Where's the spending supposed to come from? That's missing here. There is mathematically, it's an impossibility to get back to previous GDP levels. So that is ultimately why we think this rally still ultimately is going to be very, very capped. And quite frankly, it's going to look more like a square root in terms of its shape as opposed to a V-shaped recovery. Last point, just real quick, and I don't want to spend too much time on this because it can very quickly get very confusing, but there are these funds out there. They play sort of the volatility game. So when volatility gets smaller or lower or cheaper, if you will, in equities, then basically they have to buy more stocks. And as the volatility, you can see, for example, the VIX volatility has come from an extreme like 85 or around 85, and it's now down, it's called in the mid 20s. That is one of these things where these algorithms automatically have to buy more stocks. Over the past week and a half, we've seen volatility drop below 30. That's another thing where they have to get even longer. So this is kind of what's happening. But again, we think ultimately this will be equities are very capped on the upside in the bigger sense. And anyway, folks, I hope this is helpful. Just trying to give you some perspective. As always, if you have any questions, comments, or anything, leave it down below. Give us a thumbs up like if you enjoy this, and subscribe and spread the word. Thank you, and I'll talk to you soon.